Welcome back to Prosperity Pathways. I'm the OG, your guide to mastering personal finance and creating wealth. In episode 10, we're exploring tax-efficient investing strategies that can help you maximize your returns and keep more of your hard-earned money. Let's dive in and discover how to make the most of your investments while minimizing your tax burden. Understanding taxes on investments. Taxes can significantly impact your investment returns, so it's essential to understand the different types of taxes that may apply. 1. Capital gains tax, levied on profits from the sale of an investment, like stocks or real estate. Capital gains can be short-term, held for less than 1 year, or long-term held for more than 1 year, with different tax rates depending on your holding period and income level. 2. Dividend tax, applied to dividend income received from stocks or mutual funds. Dividends can be qualified, eligible for lower tax rates, or non-qualified, taxed as ordinary income. 3. Interest tax, imposed on interest income from investments like bonds, CDs, or savings accounts. Interest is typically taxed as ordinary income. 4. Mutual fund capital gains distributions. If you hold shares in a mutual fund that sells investments at a profit, you may receive capital gains distributions, which are subject to capital gains tax. Tax-efficient investment strategies. Here are 5 strategies to help you minimize your investment-related taxes and maximize your after-tax returns. Invest in tax-advantaged accounts. Utilize retirement accounts like 401ks, IRAs, or Roth IRAs, which offer tax-deferred growth or tax-free withdrawals. For education savings, consider 529 plans or Coverdell education savings accounts, ESAs, that provide tax-free growth for qualified expenses. Hold investments long-term. Aim to hold investments for more than 1 year to benefit from lower long-term capital gains tax rates. Use tax-efficient investment vehicles. Choose low-turnover, passively managed investments like index funds or ETFs, which tend to generate fewer taxable events than actively managed funds. Harvest tax losses. Offset capital gains with capital losses by selling underperforming investments, a strategy known as tax loss harvesting. Allocate assets strategically. Place tax-inefficient investments, like bonds or REITs, in tax-advantaged accounts, and tax-efficient investments, like stocks or municipal bonds, in taxable accounts. Tax-efficient investment options. Consider these tax-efficient investment options to help reduce your tax liability. Index funds and ETFs. These passively managed funds typically have low turnover, generating fewer taxable events compared to actively managed funds. Municipal bonds. Interest income from municipal bonds is generally exempt from federal income tax and may also be exempt from state and local taxes if issued within your state of residence. Roth IRAs. While contributions are made with after-tax dollars, qualified withdrawals from a Roth IRA are tax-free, providing tax-free growth and flexibility in retirement. Tax-managed mutual funds. These funds are specifically designed to minimize taxable events by employing strategies like low turnover and tax loss harvesting. Understanding tax brackets and planning. To optimize your tax-efficient investing strategy, it's essential to understand your tax bracket and how different types of investment income are taxed. Familiarize yourself with the current federal and state tax brackets and rates for ordinary income, capital gains, and dividends. Consider how your income and deductions may change in the future, affecting your tax bracket and the taxes you'll owe on investment income. Work with a tax professional or financial planner to develop a personalized tax-efficient investing plan tailored to your unique financial situation and goals. Tax-smart withdrawal strategies. When it's time to tap into your investments, utilizing tax-smart withdrawal strategies can help you minimize your tax burden in retirement. Withdraw from taxable accounts first. Start by liquidating assets in taxable accounts, which are subject to capital gains tax but not penalties for early withdrawal. Tap into tax-deferred accounts. Next, access funds in tax-deferred accounts like 401ks and traditional IRAs, which are subject to ordinary income tax upon withdrawal. Use tax-free accounts last. Finally, withdraw from tax-free accounts like Roth IRAs, which can provide tax-free income and preserve your assets for longer. The importance of tax diversification. Just like investment diversification, tax diversification is also crucial for your long-term financial planning. By spreading your investments across accounts with different tax treatments, you can manage your tax exposure and create flexibility in retirement. Here are some benefits of tax diversification. Flexibility. Having a mix of taxable, tax-deferred, and tax-free accounts provides more options when you need to withdraw funds. This flexibility allows you to respond to changing tax laws, market conditions, and personal circumstances. Manage tax bracket risk. By having multiple sources of income with different tax treatments, you can better control your taxable income in retirement, potentially keeping you in a lower tax bracket. Hedge against future tax changes. Tax laws and rates can change over time. Tax diversification helps protect your wealth from the potential impact of future tax hikes or policy changes. Tips for tax-efficient charitable giving. If philanthropy is part of your financial plan, you can also leverage tax-efficient strategies to maximize your charitable impact and minimize your tax burden. Donate appreciated assets. Instead of selling investments with significant capital gains and then donating the proceeds, consider donating the investments directly to a qualified charity. This way, you can avoid paying capital gains tax and receive a tax deduction for the full market value of the assets. Use a donor-advised fund, DAF. A DAF is a tax-advantaged investment account specifically for charitable giving. Contributions to a DAF are tax-deductible, and the funds can be invested and grow tax-free. You can recommend grants from your DAF to your favorite charities over time. Consider a qualified charitable distribution, QCD. If you're over 70 and a half and have a traditional IRA, you can make a QCD directly from your IRA to a qualified charity. QCDs count towards your required minimum distribution, RMD, and are not included in your taxable income, which can help lower your tax bill. And that's a wrap. You now have a comprehensive understanding of tax-efficient investing strategies and how to maximize your returns while minimizing your tax burden. By applying these strategies to your own financial plan, you can keep more of your hard-earned money and achieve your wealth-building goals more effectively. Thank you once again for joining us on Prosperity Pathways. If you found this episode helpful, please hit the like button and subscribe to our channel for more valuable content on personal finance and wealth creation. In episode 11, we'll be discussing various strategies for managing debt. Until then, stay curious, stay invested, and see you soon on the path to financial mastery.